When you buy a new car for your business, if you aren't discussing with your CPA how to max out the write-off, you're losing money. Two different ways to take auto deduction: the standard mileage rate or the actual expenses method. Once you take the actual expenses method on a car, you can't go back to taking the standard mileage rate in future years. So it's extremely important to choose the right method in the year you buy the car. Here's some rules of thumb on how to know which method to use. First, if it's a low-cost vehicle and you're driving a lot of miles for business, take standard mileage rate. Two, if you're not driving a lot of miles for business purpose, the car is at least moderately expensive, and you're using the car a majority of the time for business purposes, take the actual expenses method and use bonus depreciation in the first year. Three, if it's an expensive vehicle and you aren't putting a ton of miles on the car, consider leasing the car instead, as you won't have to recapture the depreciation you take when you trade it in. And you can probably get a cheaper low mileage lease. Four, if you use the car for business purposes less than 50% of the time or expect to do so in the future, you must use the standard mileage rate method. And fifth, if it's an SUV or truck over 6,000 pounds, take the actual expenses method. A lot of the time, these cars get less miles per gallon, meaning you'll be spending more on fuel. You'll have more fuel to write off. You'll also get to depreciate more in the first year. Now, electric or hybrid, higher miles per gallon, less fuel to write off. Standard mileage method wins out a lot of the time in the long term, but these are a lot less tax friendly now that you no longer get a tax credit for buying electric vehicles.